This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
This is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we're going to provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we're talking midterms and what industries stand a chance against political gridlock in the coming months. Plus, can China actually escape from its zero-COVID policy without provoking a major health crisis? Markets really want them to. But first, let's take a look at central banks, particularly the Bank of England, going in opposite direction than the Fed did. Yes, they hiked 75 basis points, but said that the price path and the terminal rate that the market's pricing in may be overdoing it a bit, and what that winds up meaning then for UK banks. For that, let's bring in Bloomberg Intelligence senior EU banks analyst Jonathan Tyce. Jonathan, talk to me about the BOE and what bank CEOs are thinking right now.
Sure. I think the most interesting thing is that if you go back a month when swap rates were going through the roof, we had no idea what the Bank of England would have to do. There were talks of a sort of 175 basis point, 200 basis point hike. Everything shut down. And now that we have a slight change of government, new PM, a little bit more sensible policy, things have settled down. But the fact is, we certainly have an issue with imported inflation. The pound is still weak. And we certainly have an issue with liquidity at the higher loan-to-value range of mortgages for banks. So, yes, things have settled down, but I think we're far from out of the woods.
Well, exactly. And the reason why the peak rate's going to be less than maybe the market's pricing is because the economy is so bad. He's not saying that inflation is coming down. It's because there are real cracks in the economy. So I'm trying to work out what kind of economic outlook that's going to mean for banks operating within the UK.
Well, I mean, the good news is, having been around quite a long time since the late 90s looking at banks, we're in a better position than we were. And if I compare it to sort of 2008, you look at leverage, you look at capital, we're in a much better position. But what we haven't had before is this level of inflation and kind of household income squeeze. Similar to the US, the UK economy is 65-70% GDP driven from consumer. So clearly, if you have energy rates going to the levels that they have, we know that it's only going to get more painful, and the banks are aware of that. So it's not pretty, but we're starting in a much, much better place.
Well, talk to me about the mortgage market then. Obviously, unlike here, we get 30-year fixed. That's kind of the way to go. There's variable rate mortgages over where you are. How many homeowners are in variable rate mortgages, and what banks provide those mortgages, and where's the risk there?
Well, I mean, if you have a mortgage over here, as a rule, historically, you'd have been on a 2-year fixed. So we've got kind of the roll-off coming up. People are going to go from having a mortgage rate of 1.5%, 2% to 6%.
That's crazy.
It's painful. You couple that with the fact that, let's say that adds £1,000 to your mortgage, so you go from 20% of your disposable income to 40%. Put an extra 20% on because your energy bill's just gone up. That's the biggest unknown. So at the moment, I have no doubt the Bank of England is talking to the banks saying, okay, we don't really want to push mortgage holidays, but how do we manage this? So it's not pretty. But that said, we have a lot of renting here. We're probably not the most overheated housing market in the world. Look at Australia, look at Canada, look at Sweden. There are markets that are worse, but it is a big problem.
Which banks are most exposed if someone can pay an extra $1,000 a month when they have to refi?
Well, I mean, Lloyds Banking Group is 20% of the mortgage market over here, but that said, they're probably one of the most solvent, and they're very, very efficient. NatWest is another big domestic play, but as I say, the good news is the starting point is very, very good. The question is, what happens to growth from here for the banks? What happens to EPS? And then do they get ahead of the curve and start sort of under-reporting profits now to build a cushion? And I think the answer is, and we've seen it in 3Q as well, the banks are a little bit ahead of the curve. They don't want to be caught enjoying rising interest rates and squeezing customers at the same time.
If we get a kind of economic outlook that the BOE kind of forecasted. I mean, if you look at their forecasting, UK is already in a recession. They're looking at a recession that could last 2 years. I mean, it's not great. Where's the biggest risk for banks in terms of their loan book?
Well, I mean, bizarrely, COVID's actually helped with this, because if you look at the cash cushion, because of all of the excess liquidity that was pumped into the system that corporates have, you look at the savings that were built up when people could go out and spend, and you look at where we're coming from because rates were cut to 0.1%, again, we're in a much better position as a starting point. In terms of where it goes from here, well, certainly it means that our expectations that things would go onwards and upwards are wrong. But that said, the ability of the consumer and also corporate to weather most of this, particularly large corporate, is pretty good. It's the SMEs, the small corporates, and that's why, if you look at Europe, the market's concerned about Italy. Italy and Spain, SME businesses, small and medium-sized enterprises, they are the lifeblood of the economy. The UK, not quite as much, but it's the smaller businesses that we really have to worry about.
What's your favorite bank right now? What UK bank is going to navigate all of this the best, and which one's going to have the hardest time?
Bizarrely, if you'd asked me this 5 years ago, I would have said, well, NatWest is the one with all the problems and Lloyds is the quality one. NatWest has emerged from the shadows and Lloyds is still doing very well. So, A, we're not allowed to have favourite banks, but B, as I've said, we are in a much better starting position than we were previously.
Are stocks priced for that?
Stocks are near multi-year lows on any metric I care to look at. So the market got ahead of itself and said, well, you know what, we think it's going to get a lot worse. I think the government, the taxpayer, is going to take a bigger share of the burden than share prices is currently discounting. So in terms of downside from here, I'm not that worried about the banks, but the fact is the market's quite right to say, well, show me.
All right, Jonathan. Amazing as always. I love your insight. Truly appreciate it. Jonathan Tyce, Bloomberg Intelligence Senior EU Banks Analyst. So coming up on the program, we're going to discuss what industries you got to be watching after the U.S. midterm elections. You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele. It is 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
It's that time of year. The U.S. midterm elections are just days away, and it's going to really dictate certain companies' future, whether or not you get political gridlock, whether or not you get a Republican Congress or a mixed Congress. Again, let's break it down, look at the industries you really want to be focused on come Wednesday. For more, we want to welcome Bloomberg Intelligence Senior Government Analyst Nathan Dean. First of all, let's set the stage in terms of what's your best guess as to what kind of Congress we're going to get come Wednesday morning.
So you're definitely going to have a divided government. I mean, the House of Representatives, I think, will most likely, I think that nobody in Washington is anticipating that the Republicans are going to lose the House. That's the House. So you are going to have a divided government. Now, the question is on the Senate. I mean, in the best case scenario, the Democrats have 50-50 and everything just remains the same in the Senate. Worst case scenario, they could lose several seats and then you have a Republican Senate. But what we are telling our clients is that no matter what happens on Tuesday, political gridlock is going to increase. But what we are saying is political gridlock is normal. I mean, divided governments happen all the time now, especially. But that does not mean things don't get done. It just means things get done in a different way. So we are definitely seeing a lot of different sectors and asset classes and equities that could be exposed off of this election over the next 6 to 9 months.
I hate saying this, but is this time different in terms of gridlock? Like, this gridlock feels much more fired up than I might think otherwise. Is that true, or is it just going to be gridlock status quo?
Well, it's definitely fired up in the public perception, but is it fired up on how actually bills and things get done?
Good distinction.
I would argue not, because what happens is if you have the current government, right, you have the Democrats in control of the House and the Senate and the presidency, you have broad economic fiscal spending bills, the reconciliation bills and so forth like that. In a divided government, that goes away. But you still have bills passing. What happens, though, is that these bills get attached to must-pass pieces of legislation, government spending, debt ceiling. They happen usually about once every 3 to 4 or 5 months. So then you get this brinkmanship where the news cycle goes wild and we're going to have a government shutdown or the debt ceiling is going to be, breached or whatever. But what the lobbyists and the policymakers are doing at the same time are attaching bills to these must-pass pieces of legislation and using them as vehicles to get to the president's desk. So these smaller subsector bills, for marijuana, for example, marijuana banking bill we're tracking right now for the lame duck, very important to the marijuana industry. Does it get enough floor time, though, to pass the actual Senate? Not so much, but it could be passed as an attachment to another bill and sent to the president that way. So it's just different on how bills passing.
That is a great point. So which industries could see the most change, and which industries are we going to talk about but nothing actually happens?
So, we've put out a pretty in-depth report in terms of how we think these certain sectors are impacted. Marijuana stocks. With Republicans taking control of the House and or the Senate, the era of legalization is probably going to be pushed off. But, it could spur lawmakers to pass what is known as the Safe Banking Act in the lame duck period. And if that happens, marijuana stocks have reacted in the past to something like that. So we're calling that as one of our biggest catalysts of the month. Cryptocurrency. There is a cryptocurrency bill out there that favors Coinbase and FTX and would actually bolster, we think, Bitcoin and Ether as well. That is bipartisan, but really the biggest issue and the roadblock in it at this point is some of the Senate control or some of the Democrats in the Senate. So if you have a Republican-controlled Senate, this bill is currently in the Senate Ag Committee, could have a speedier way of passage, and then probably in the first half of next year. Other things that we're looking at, drug makers could be exposed by some language coming up later in the half. We think credit card issuers, Visa and MasterCard, could be exposed by a bipartisan bill. Again, if the Democrats control the Senate in that case, then you'll see a speedier passage. But ultimately, if you're on the fixed income side, the most important thing, I think, for you is the debt ceiling fight that's probably going to come in the third quarter of next year. We just saw language from Senator Bernie Sanders saying that the Democrats should use the lame duck period to get rid of the debt ceiling fight. If that happens, T-bills are certainly going to be impacted. The fixed income traders are certainly going to be having some concerns over that because Kevin McCarthy has said that he wants to use that as leverage to get policy goals done.
But wouldn't that lead us to a government shutdown, and then Republicans would have to say they were responsible for the government shutdown? I mean, honestly, I feel like we've seen this movie so many times, and the only really big time it hit was 2011.
So the government shutdown, from an equity perspective, it really doesn't all that matter. I mean, it impacts those of us who live in Washington, D.C. We can't go to the museums and so forth like that, and government workers usually get paid afterwards. Politically speaking, however, it's usually the party that causes the shutdown that pays the political price. However, there have been instances in the past where presidents have been backed into a corner. For example, in 2014, there was a provision inserted to a spending bill that repealed the Dodd-Frank swaps push-out provision. This gave $40 billion in capital back to the banks. The Republicans signed it, put it into a bill, and right before the holidays, they sent it to the president and said, we're going home. And so President Obama was forced to make a choice. Do you shut the government down in favor of this Dodd-Frank swaps out provision, or do you keep the government working? And a lot of consumers out there didn't even know what Dodd-Frank is. So when you're talking about things like the SEC climate change rule or market structure rules or
forget it.
Exactly. The average American consumer probably wouldn't care all that much. So everybody knows this tactic is coming. What we're telling our clients, though, is as a result of this, anytime you get close to one of these must-pass pieces of legislation like a government shutdown or a debt ceiling or even something like the National Defense Authorization Act, pay attention, because that is when these smaller subsector issues get inserted and they either get passed or they get repealed and so forth. So it's usually about busy time, about the week leading up to that deadline.
At the same time, the economy could be in a rough spot. We're going to hear things about taxes or stimulus. Like, where's that conversation going to start to kick up over the next few months?
There are certain tax issues next year that have to be dealt with because of expiration dates. You'll hear that, and you'll hear some issues regarding to that. But the real big story as we get into these funding fights is retaining or restricting government spending. It's like the deficit hawks are going to come back next year. And one of my colleagues around town said that, the deficit hawks only fly in a divided government. I love that phrase because it's so true. And so because of this divided government, you're going to see deficit hawks saying, we need to cut this, we need to cut that. So every single time we get to a government funding fight, there's going to be a fight over spending and how we can control it.
Great stuff. Really appreciate it. Wonderful analysis, Nathan Dean. Definitely check into all his stuff as we go through this process. Bloomberg Intelligence, senior government analyst. All right, coming up on the program, we're going to talk about lending against climate future and also what that actually means. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele, and it is 25 minutes past the hour. This is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide. So banks are racing right now to reduce their financed CO2. Targets and data, though, are falling short, and you got a threat of climate-related risk continues to grow. Let's get more on what that means with Bloomberg Intelligence Director of U.S. ESG Research, Kane. First of all, what is financed CO2?
Right. So financed CO2 is really what we consider to be Scope 3 for banks. So it's the emissions associated with the lending that they provide to carbon-intensive industries, such as...
in, if they lend to oil companies do stuff.
Exactly right.
Okay. And how are they trying to reduce it?
Right. So we see about, in our peer set of 54 banks, 40 of them have joined the Net Zero Banking Alliance, which suggests they're going to align their lending portfolios with net zero by 2050. But when we actually look to see what the interim targets are, typically looking at 2030 as an important benchmark year, we see that banks are setting targets to reduce their lending exposure to the most carbon-intensive industries, coal, power generation, and oil and gas.
Are they actively selling loans or trying to get out of these loan agreements, or is it just about not providing more loans to coal companies in the next 20 years? Because it feels like the latter isn't going to be enough.
Right. So I think it really is the latter, where they're not necessarily going to sell loans that they had made in the past. Mm-hmm. It's more changing behavior going forward, so reducing their exposure to those carbon-intensive industries.
How is that going to be enough, though?
It's a good question, and I think, in order for things to really be enough, we also need to look at the kind of other side of the equation, which is the sustainable lending practices and seeing, what these banks are doing with respect to lending to solar, renewable energy, things like that.
Who wins? Who gets an A+?
So right now, we turned our analysis of the 54 banks into our BI carbon scores for banks, and we see companies like Danske and Citi in the lead. And a big part of that is because when we look at their targets and we compare where we think they're going to be in 2030 with their finance emissions against where the IEA net zero by 2050 pathway suggests, they're among the few banks that are actually meeting that benchmark.
Who's the worst?
So we see a lot of banks who are not providing any data. So that goes both ways. So those banks that don't provide any loan data to Bloomberg League, for those, we don't really have the ability to calculate their historic emissions, and they don't have targets, so we can't forecast their emissions. For those that do provide information, we see banks like the State Bank of India, Commonwealth Bank of Australia lagging because they're not really setting targets and they have fairly carbon-intensive loan practices now.
Now, obviously, the climate change issue is going to get worse and worse, and it's going to affect more and more industries in derivative ways. And I'm wondering when you think that investors actually start to value these bank stocks on something like that. Like, there's so many other things to value them on. Like, when does it become this or part of it? Yeah,
it's a really good question, and I think it's hard to put an exact time on it. We did see the European Central Bank in the summer announce the results of their initial climate scenario stress test for about 120 European banks. And one of the things that they came up with is that they're expecting a 70 billion euro loss for the banks that participated in the test due to changing industries, due to the impacts of climate change. So I think once these impacts start to materialize, investors will certainly pay attention.
So they have to see the pain first before they're like, oh, okay, we support you in making, we'll start valuing you at this, basically, at the end of the day.
I think that might be the case, unfortunately.
We're also seeing sort of like an anti-woke investing thing coming up. Is that affecting the calculus at all?
It's interesting, and there's certainly been a lot of discussion about the anti-ESG movement and what exactly they're going to be able to accomplish, especially if we see change in kind of political control after the midterms. And in my opinion, I don't see it having a big impact in the overall space. I do think, we've seen some states pass legislation that prevents them from doing business with certain banks that may account for ESG in their investments, et cetera. I don't see it having a big impact overall going forward, though.
And then to wrap it up, we were talking a lot about coal and the energy industries. What are some of the other industries that you think that these banks are going to have to pay closer attention to over the next, 10, 20, 30 years that will be responsible for more emissions that they need to kind of start tackling?
Very few of the banks, so about 60%, provide some level of disclosure on their financed emissions. And when we look within that, they're really starting with the most carbon intensive. So again, oil and gas and power generation and coal to some extent. We see some banks also providing information on lending to industries such as automobiles and cement. So I think, those are other very carbon intensive industries that are top of mind. But I think what we're seeing, of course, is that banks are really going to have to think about this type of analysis for all industries that they're loaning to.
No, that's fair enough. Eric, thanks a lot. Really appreciate it. Eric Kane, Bloomberg Intelligence Director of U.S. ESG Research. Coming up on the program, is there a reasonable escape from zero COVID for China? Investors really want there to be. You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele, and it's 39 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
China's zero COVID policy initially, rewind 2 years ago, provided a shield from the virus. And now, though, it's really a trap. Escaping it without provoking a major health crisis is a huge challenge for China. So let's get more on this. Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli joins us now. Sam, first off, the zero-tolerance COVID policy worked like way in the beginning. Where did it go so wrong?
Well, honestly, Alex, nothing's gone wrong. They're still managing to keep their hospitals clear of COVID patients mostly and very low levels of deaths due to this infection. So you can't say that's gone wrong. What has gone wrong is the fact that the price you pay for achieving that, which the country appears to continue to accept, is that you have to keep people apart from each other, locked down, quarantined, unable to conduct normal life. That's the price. And they seem to be relatively happy to still keep doing that, at least the government is.
I don't understand. We're almost 3 years into this pandemic, and there are vaccines out there. Why isn't China just buying a boatload of mRNA vaccines and then opening up all the doors?
Honestly, Alex, I'm not even sure they need these mRNA vaccines. When you look at the data that's emerged over time, even with their own vaccines that perhaps require at least 3 or maybe even 4 shots that we thought weren't as effective, the types of immunity that it gives you, that background immunity with your cellular immune response, seems to be, with the data that I've seen, similar to what you get with mRNA shots. So I don't think it's a matter of do they need mRNA shots or whatever. I think it's a matter of them needing to get people to take the shots in the first place.
Why do you think it's having such a hard time doing that?
I think policies, that's the bit I've not understood very well. They seem to have no problem forcing people to test a lot and forcing people to stay indoors than forcing them to take a vaccine. But let's not forget, we are all sitting here having been vaccinated, having been infected, and at least some people suffer very badly from long COVID. That's not going to change with mRNA or any other vaccine. That's going to still happen. So what the country has to do now is to figure out at what point it's prepared to go through that process.
At the same time, I'm hearing the new variants that totally ignore the bivalent boosters that everyone is getting right now. I guess I'm wondering, how serious do we need to be taking this headed into winter? And then we'll pivot back to China in a sec.
So the question is, what do you mean by how serious? Those variants, this virus continue to evolve. It is early in its evolutionary path, probably. Maybe the other coronaviruses did the same thing when they first came into humans. Nobody knows. What we do know is that, at least from the antibody level, your bivalent booster shot is going to be less effective against BQ1X, be it 11, 111, whatever variant comes along, or the XBB variant. It seems to be that those are supremely even more immune evasive. Therefore, you have a risk of being bivalently boosted and catching an infection 3, 4, 5, 6 weeks later. But the protection against severe disease should still be in place because that was given to you by your third dose already.
Right. Okay, so we're living with this. Are we going to be in a world where we're going to get like annual COVID shots like the flu shot or biannual shots maybe? And the more shots we get, the harder is it going to be for China to really open?
Correct. The question I have about the constant boosting is, and Moderna had the results, and they showed some data relative to flu, that you get a lot more deaths with COVID. Yeah, all that's true. The thing is, what they really need to do is to split the data out and show the people who have been vaccinated and those who have not. Those who have been vaccinated with Paxlovid have a far lower risk of, potentially down to the risk of flu in terms of death risk. So the question is, flu, we know the virus, it's not just that, it's a different virus every year. It's not like SARS-CoV-2 with 2 mutations, 3 mutations, 10 mutations. It's a different virus, which is why we get a new vaccine every year. Do we really have that situation with COVID, with SARS-CoV-2? I would say at the moment that is not the case.
Here's another question. Because we're still seeing, especially in China, people masking, people being super isolated, are we seeing a resurgence in other kind of diseases and viruses because our immune system was so isolated for the past few years?
Yeah, so I think what's happened is, as I'm pretty sure you know, around all the friends around you and people that you know, how many people are sitting at home with some kind of an infection that is not COVID. They try to make it COVID by doing 10 tests, but it doesn't come out positive. That's exactly what's happened. So it's not like we've lost immunity to stuff. It's simply because for a couple of years we had no exposure to these viruses. So we got what exactly happens with COVID. The immune system's immediate defense has waned, has contracted. So you get these infections. But I don't think you're seeing people massively ending up in hospital because of it. You just have a lot of people sniffling and not feeling great at home.
Fair enough. And that's something that you pointed out from the beginning. It's just sort of like how we measure victory in these situations, which I still feel like none of us truly understand or will accept. Always a pleasure. You're welcome here anytime. Sam Fazeli, Bloomberg Intelligence, Senior Pharmaceutical Analyst. All right, let's stick with the healthcare sector. We're going to shift over to Eyecare. Now, I'm pretty bad with my eyesight. I wear contacts, I wear glasses. I have a vested interest in this segment. Apparently, it's going to see significant opportunities and room for expansion in the coming months. So let's get more on this with Bloomberg Intelligence Senior Biopharmaceuticals Analyst and Hunter Van Kirk. First of all, I never thought of like Eyecare as a specific segment of the market. Who are the players in this, and where is it right now in terms of its actual growth?
So the biggest players are Johnson & Johnson by a huge lead, with Cooper, Alcon, and Bausch & Lomb, which is a spinoff of Bausch Health, as kind of the key players. And we've dived into this market with a 650-person survey, which has informed our view that there could be 1% to 2% upside to the mid-single-digit growth expectations and just the contact market overall, and particularly see Cooper and potentially Alcon as gainers of market share from that market leader, Johnson & Johnson.
How fast is the market actually growing right now? Are people's eyesight getting worse or better?
Worse. No, that's the right question. Overall, we see rising myopia rates, which is nearsightedness, low corrective surgery penetration, and a shift to digital channels as all boding well for these contact makers.
Shift to digital channels. So that means that I would just go and order my contacts online rather than have to go to the eyeglass store and do the whole thing.
Exactly. And there's been recent outsized growth in this, across the board. But we think that's consistent with contact lens channels specifically and would benefit that market expansion.
How competitive is it? I know that Johnson & Johnson has like the market share. So how competitive is it on a price level for these guys?
Yeah, Johnson & Johnson is the current leader, and their AccuView Oasis line, according to the survey that we just did, was about 28% of all respondents. And they just launched the newest generation of this line in June, so we think they will maintain the dominance in that line. But we think overall, Cooper and Alcon that we discussed will encroach on their overall market share, given the number of wearers who have not changed lenses in the past 5 years.
But what about in terms of pricing? Like, are they all competing for me? Like, does Oasis, say, have pricing power, or am I going to go with like whoever's cheapest?
It depends a lot on your model. It is a payer, an insurance model, although sometimes less so than classic pharma models. So on the payer side, just like pharma, you will have the newest brand as probably the most expensive, and people may select cheaper alternatives. But you constantly want to be investing in the innovation, the new fits, and you will you will see gains from that. They are better for your eyes. They now have UV sun protection in the newest products. There's some exciting things going on.
That's cool. I didn't know about that one. So here's a question. If LASIK surgery becomes cheaper and people just start doing that, what kind of dent is that going to make into the eye care world?
That could make a significant dent, and we did identify in this survey that cost was the significant hurdle for most people. Mm-hmm. It is usually not reimbursed. It's considered an elective surgery, and nearly 57% of our respondents identified cost as the main reason for not pursuing it. From my perspective, it's just because I get nervous about it going wrong, which is probably another 30% of respondents, but most people are most worried about the cost.
No, fair enough. My eyeglass guy was like, LASIK sucks. And someone else was like, well, they're telling you that because they wants to keep your business for contacts. I was like, oh, God, so conflicted. Don't understand. Who are the companies that do LASIK? Like, who would benefit on that end?
Interestingly, it's still the same companies, so it wouldn't be coming from the manufacturers themselves. It would be maybe more from your particular spectacle operator. But no, it's still Alcon, Johnson & Johnson, kind of those are the main players.
Really interesting. I totally didn't know that. Why are our eyesights getting worse, by the way? Do you know this?
A lot of it has to do with screen time, as we all know. There have been rising myopia rates globally. They are particularly high in China and Asia overall, approaching 60-70% in some of those countries. And it's a focus it's something you see stronger in urban areas than rural areas, kind of indicating that it is based on too much screen time and reading and not enough just enjoying Mother Nature, I suppose. And so that's where one of Cooper's products becomes particularly exciting. They have a new contact lens that is supposed to slow the progression of myopia, particularly in children.
That's interesting. So the contacts can actually help correct things, not just like help you see better.
Slow them down, yeah. So your vision, wherever it is, presumably if you have the contacts, you already have poor vision. But most people have their vision worsens through their teenage years and maybe levels off somewhere in their late 20s. And this would slow down that worsening of their vision.
All right, AH, thanks a lot. Really appreciate AH fan Kirk, Bloomberg Intelligence Senior Biopharmaceuticals Analyst. And that wraps up this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember that you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele. It is 57 minutes past the hour, and this is Bloomberg.